In today's video, I'm going to show you what the smallest portfolio you need is to fully live off of dividends. Hey everyone, I'm James Knoll, founder of Root Financial, and I'm here to show you how you can get the most out of your life with your money. Now, I love dividends. People love talking about passive income, and they often talk about online shops and real estate and other things, which are all wonderful things. But a lot of them aren't truly passive. They still take a lot of time, effort, and energy, and some people love doing it and they can provide wonderful returns, but in my mind, it's not truly passive. What I love about dividends is it's truly passive income. You buy stock in an amazing company, and that company distributes its profits to you in the form of a dividend. The question is, how much do we need to have in that company or in a portfolio so that we can have enough dividends to fully replace our income? Here's where people get discouraged with this though. They'll go to Google and they'll say, Google, how much money do I need in my portfolio to fully live off of dividends? And let's assume I want $6,000 per month. And up comes this article, and this article says, look, if you want $6,000 per month, that's $72,000 per year. If you have a portfolio that's generating 3% in dividends, you need to have about $2.4 million in your portfolio. Then people get discouraged. They say, I don't have $2.4 million in my portfolio. Does that mean I'm nowhere close to being retired? No. Let's actually look at this more accurately. What these articles often miss is they miss the big picture. They miss the context in which you need those dividends to fully be able to retire and live off passive income. So let's actually work through this accurately, and let's start with that example. Let's assume you do want $6,000 per month, which is $72,000 per year. Well, right off the bat, before understanding dividends or your portfolio or any of that, most people aren't living only on their dividends. Most people aren't living fully off of their portfolio. Now, maybe they are if they retired really early and they don't have pension or they don't have Social Security, or they don't have real estate income. But the majority of people who are actually fully living off their portfolio also have some other income source. So when you're looking at this, back out other income sources that you already have. So if I want to live on $6,000 per month and I'm retired and my spouse is retired, maybe I have $2,000 per month coming in from Social Security. Maybe my spouse has $2,000 per month coming in from Social Security. That's already $4,000 per month. And if I want $6,000, it's only the remaining $2,000 per month that I actually need in order to fully be able to support my standard of living. So right off the bat, you don't need a portfolio to generate $6,000 per month for you. You need a portfolio to generate $2,000 per month for you, which is $24,000 per year. So now the question is, where do you get that? What stock do you put your money in? What portfolio do you put your money in to generate $2,000 per month or $24,000 per year? Well, let's take a look. Let's look at some actual stocks, but before we do so, understand that none of these are actual recommendations. I chose some stocks at random to illustrate a point, and we'll actually get through what you should be doing or how you should be thinking about this. But let's start by exploring some very real world examples. Let's start with Simon Property Group. So you can see here, Simon Property Group's dividend. It's, as of this video, 6.68% per year. What that means is Simon Property Group, what they're doing is they're bringing in revenue and income, and you as a stockholder of Simon Property Group, they're distributing some of that to you in the form of a dividend. Well, if all of your money was in Simon Property Group, you'd have to ask yourself, what's the lump sum value or what's the portfolio value needed so that 6.68% of that equals $24,000 per year? Another way of looking at that, and let's look at this calculator here, is if we need $24,000, that's the dividend amount we need to supplement our Social Security to give us $6,000 per month, I can divide that number by 0.068, so 6.8%, and that equals about $353,000. In other words, if I had $353,000 in Simon Property Group and this dividend continued, it would be able to supplement or it would be able to make up the difference between what I have coming in from Social Security and how much I actually want to live on. That number's a whole lot different than the 2.4 million we talked about at the beginning that many of these articles would say you would need to have to be able to live fully on dividends. Now that's just Simon Property Group. Let's take a look at some other examples. Let's look at AT&T, for example. You can see here, AT&T, as of this recording, the dividend's about 6.2%. So a little bit different than Simon Property Group. What does that mean for you? Well, what that means for you is if we go back to our calculator here and say $24,000 per year is what we want, and divide that by 0.062, so 6.2%, well, that tells us we need about $387,000 in AT&T stock if we want $2,000 per month on average to supplement Social Security and give us $6,000 per month. So you can already start to see that's a different number than had we been fully invested in Simon Property Group. Let's continue with a couple more examples. Another stock that pays dividends is Johnson & Johnson. You can see right here, the current dividend on Johnson & Johnson is 2.75%. So once again, back to our calculator, $24,000 per year divided by 2.75%, that means we would need about $873,000 in Johnson & Johnson stock to give us enough in dividends to support our lifestyle needs on top of Social Security. Let's look at one final example, Apple stock. Apple stock doesn't pay much of a dividend. You can see here it's 0.56%. So if we were saying, well, how do we do this all if we want to only invest in Apple stock? Well, $24,000 per year divided by 0.56%, we would need about just under $4.3 million to make this happen. So what does this all mean? If we're in Simon Property Group, we only need $360,000. If we're invested in Apple, we need $4.3 million. There's got to be some middle ground, right? Well, I show this to illustrate the point. We shouldn't ever be just invested in one stock, and you can't just go say, what are the highest paying dividend stocks? Because you might miss out on some great companies like Apple. So what we really want to do is we really want to say not just what's Simon Property Group's dividend or Apple's dividend or Johnson & Johnson or AT&T. These might be great companies that should be part of your portfolio, but you never want to own only one company. You don't want to own only one company that you're relying on dividends for, because that could have some pretty bad results over time. Take a look at AT&T, for example. Over the last 25 years, AT&T performance has been about 4.4%. So on this graph here from Google Finance, this is just the price of AT&T. So over this whole time period, it was also paying a dividend, but you can see the price has actually declined. So as profits been paid out to shareholders, the value of the company itself has declined, but it still had a return total of about 4.4%. Compare that to the S&P 500 as a whole, and it grew by about 8.3%. So you can see that's the risk of investing in just one stock. Sure, there's a nice healthy dividend, but the stock itself, the performance of the stock itself has not been great. It's underperformed the market by a pretty significant margin. Or take a look at General Electric. General Electric back in 2000 traded, when you adjust for stock splits and reverse stock splits, about $465 per share. As of this recording, it's in the mid $70 per share. So you bought General Electric at that time to say, oh, there's some dividends it's paying. It's a strong company. It's a great company. Well, if all your money was there, you can see the rapid decline of the value of your dollars, and it really isn't generating what it once did. Not only did the price decline, but as you can see from this chart here, what this is showing is this is a history of GE's dividends. And you can see going back to 2000, dividends were as high as 41 cents a share at one point. Then they dropped to 16 and they started to raise to 18 cents, 19 cents, 20 cents, all the way up to 28, 31 cents per share. And then they started to decline. And if we go all the way up to today, what you see is the cash dividend today is 8 cents per share, but that's after an 8-to-1 reverse stock split. So the equivalent of about 1 cent per share today. So when you buy one stock, depending on dividends, number one, the value of that stock could completely plummet. But number two, companies can always cut their dividends. So this is why you don't just own one company, you want to own many different companies and say, what's the dividend yield on this portfolio as a whole? And that's a much better way of looking at it. Let's take a look at an example of something this might be able to look like. And again, not a recommendation at all, but more just something to illustrate what we're looking at here. The Schwab US Dividend ETF, it's yielding as of this recording about 3.27%, as you can see right here. What this ETF does is it's saying we're not going to just go buy Johnson & Johnson. We're not just going to go buy AT&T or Simon Property Group, but can we diversify across many different companies that are paying a dividend, and the average dividend of these companies as a whole is about 3.27%. So now if we go back to our calculator and say we need $24,000 per year, and we're going to divide that by 3.27%, what that calculation gives us is $734,000. So if you have a portfolio of $734,000 and it was all invested in this ETF, which again is not a recommendation, but just for illustrative purposes only, you're going to be able to generate a dividend that on top of your Social Security, on top of your spouse's Social Security in this example, gives you $6,000 per month. And the nice thing is this example is a whole lot more attainable than the $2.4 million that you might need when you read about this of how much do I need in my portfolio to generate a dividend yield that I can live on. So this is how I encourage people to look at dividends. This is how I encourage people to look at passive income. Don't buy one stock. Don't even buy just a couple stocks. Truly, you do need to continue maintaining that principle of diversification. Companies can cut their dividends. Companies that pay high dividends might continue to do so, but the value of the company can plummet. So continue to diversify, but if you're doing that in a way that makes sense, you can have a portfolio that you can live on just the dividends, which means the balance will continue to grow for you. Now, myself personally, I don't actually believe that a pure dividend portfolio is actually the best way to do this. I believe there's other methods that you can employ for portfolio construction, portfolio design that will actually allow you to live on much more than just the dividend. If you want to see how you can sustainably spend rates between 5.5% or more from your portfolio, be sure to check out the video above so you can see exactly how to do that. Once again, I'm James Knoll, the founder of Root Financial. If you're interested in seeing how we help our clients at Root Financial get the most out of their life with their money, be sure to visit us at www.rootfinancialpartners.com.